Hello, everyone. Today on the Final Bar, I'm talking with John Lewis, portfolio manager at Dorsey, Wright Money Management. We'll talk about the market environment here. Nice push to the upside, nice rally going into the close. We've talked about sort of the overbought conditions, the signs of market exhaustion with trends moving higher, but momentum starting to roll over, those bearish momentum divergences that we've highlighted on charts like Amazon, some semiconductor names and otherwise. The market not caring too much about that continuing push to the upside as we await the latest inflation data tomorrow. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis, the technical toolkit really designed to help you understand the markets as reflected in stock prices. When we look at stocks and ETFs, we can really dissect the performance of different asset classes, different sectors and industries, and focus on what's working and what's not. A lot of times when I find investors running into trouble, it's because I think you can attribute it to what I would call poor market awareness. The market does something, a position moves against you, and you just don't have a good handle on whether and how that's going to happen and how that's going to impact your positioning. By focusing on a good routine of analyzing the charts, as we like to advocate on the Final Bar and elsewhere on Stock Charts TV, hopefully you have an improved market awareness and less uncertainty, less confusion about what's happening out there in the markets. With that as a setup, let's talk about the market recap. Let's talk about what happened today. Again, a nice up move, but we'll look at the major averages and how they played out. First, I do want to share a poll with you. As always, we have a polls going on our live, on our social media accounts, and also on our YouTube channel, of course. So subscribe to us there. You won't miss the next one. We asked you recently which asset class performs best over the next 3 months. Let's keep it simple and big picture. Stocks, bonds, gold, the dollar. So what's interesting about this one, stocks, about half of you, 51% voted stocks. And again, 3-month time period may be an interesting one. Interesting if we talk about a 1-month horizon or a 1-year horizon. But we went with about a quarter, which means that would take us through August, September, October, which would be the seasonally weakest part of the year. I'm very interested that 50% of us think that stocks would be the best bet out of all of these at a time when stocks actually usually start to deteriorate. The dollar, very interestingly, is testing a key support level, right? Over the last 6 months, we sort of bounced off of support, potentially starting to turn higher. Gold, maybe starting to get a little bit of a life, particularly in the short term. You're seeing a bit of a rotation higher. Bonds, of course, are struggling as interest rates are remaining fairly elevated, although today a bit of a move back to the downside for rates. So what would I vote on this one? Boy, I would probably say gold, to be honest with you, and only because I think you have to think about the seasonality as part of this. Having said that, I think the real benefit of this question is not to force you into a particular answer, but to think about what those different movements could mean for you, and what would tell you that something like gold or the dollar or bonds or even the S&P remains in the position to be in. Focus on the charts and how they evolve. That would be my number one goal for you. Let's look at the markets and how they played out today. As I mentioned, nice move to the upside and a nice push higher really in the last 30 minutes of trading. I was talking with our guest today, John Lewis, before the show, and going live right after the close often becomes a really fascinating struggle to get a lock on the markets as they are very rapidly moving on heavy volume. But we'll do our best here. The S&P finishing up about 0.2% to the upside. That's just below 4440. The Nasdaq Composite up about 0.6% as well, so not too far behind the S&P. Mid caps actually leading the way higher, followed closely behind by the S&P 600 small cap index. Mid caps were up about 1.1%. The only red you see on this front page is the VIX. Volatility coming off, but not by much, to be honest with you. It was just above 15 on yesterday's show. We're back just a little bit below 15. But overall, again, with the volatility environment, we're at a pretty low volatility level if you think about the last couple years. But if you think about the last couple weeks, we're sort of bouncing off of those levels. We're down sort of in that 13 range. Look back at like 2015, 16, 17. That's the last time we had a consistent run on low volatility, kind of like what we saw in 2021. 2021 was even higher than this, with the volatility often in the upper teens using the VIX. Looking at some other asset classes here quickly, interest rates overall moving to the downside, although the short end of the curve pushed a bit higher to around 524 on the short end of the curve. The 10-year point, which is the one we tend to refer to the most, down a bit to just below 4%. Long bond yield just above 4% as well. And so, we've talked about that 425 level on the 10-year. That's sort of the high water mark from the last 12 months. We've pulled back from there and sort of been in a consolidation phase, if not a pullback in rates, getting down around 3.25, now pushing back above and now right to around 4%. I think it's interesting to think about higher rates from here and what that could look like, particularly for the growth stocks that have been dominating the story here in the first half of 2023. The dollar moving to the downside just a bit, about 0.25% lower for the UUP, that's the dollar bullish ETF. Looking at the commodity space, the DBC, a broad commodity ETF, up about 1.2%. Gold actually finished up by about 0.4%. Silver a little bit higher, about 0.2%. For the most part, the energy parts of the commodity space having a pretty decent update, and the energy sector was the top performer. And that's an interesting change from what we've been talking about over the last couple months, right? Energy is sort of this forgotten sector continuing to underperform, and I bucket it with things like financials and others that have really been really lagging behind the market, driven by growth stocks to the upside. You're starting to see a nice improvement in energy this week, and we highlighted the OIH having a nice bounce. Now the broader XLE, which includes other things like the big integrated, starting to move higher as well, up over 2% today. We'll get to the sectors here in a moment. Just to finish off, cryptocurrencies mixed, I would say. Bitcoin up by about 0.6%, just above 30,600. Ether prices right around 1875, and that's just down 0.25%. So by cryptocurrency standards, pretty light day after yesterday's exciting fluctuations when we had the upside target of like 125,000 from Standard Chartered, I think it was. That juiced Bitcoin briefly up to around 31,000, but right back down to sort of the pre-announcement levels as we're doing the show today. Finally, in terms of sectors, you have energy number one, as I mentioned, up about 2.2%. That's for the XLE. The XLC, the communication services sector, number two, up 1.7%. Utilities, which is, generally speaking, a pretty defensive sector, up 1.3%. Industrials and financials and real estate, actually, right around 1.2%. The ones lagging behind, all 11 S&P sectors finished in the positive, but a couple of them not much of an improvement from yesterday. Healthcare, consumer staples, technology, basically flat to just a little bit up, less than 0.25% for all of those sectors. Let's look at a daily chart of the S&P 500, sort of check in on where we're at. This is today's bar here, pushing higher again. Over the last couple of days, what we've done is basically pull back to 4,400, a little below that. And now rotating back to the upside again. I sort of have the same sort of perspective that we've talked about over the last week, which was this break above 4,300, pretty significant. This pink shaded area really comprises that 4,300 level, also the August 2022 high around 4,325. That's an important Fibonacci level around 43, we'll call it 4,310. And so overall, you have this cluster of levels right around this same point. We pulled back to that support level in mid-June and then rotated back to the upside. Now we're sort of testing the upper end, testing all-time or long-term highs here around 4,450, just a little bit below that. A break above there just really continues up here, and it's almost like a mini little ascending triangle with a consistent resistance level and an ascending trend line connecting the lows. But a break above 4,450 really completes that sort of short-term breakout pattern. So right now, you actually see price behavior fairly constructive here. Higher lows continuing, but you're seeing the bearish divergence. We highlighted it on charts like Amazon. You're seeing it on the S&P itself. But again, for now, not enough of a drawdown given that divergence that we've seen here. Maybe a little less than expected. We did a YouTube video last week on the QQQ and some different scenarios. That's on my YouTube channel called Market Misbehavior. Talking about 4 different potential future paths and what they might look like. And, when you look at the Qs, it's, again, very similar pattern. We have, not as much of a divergence because the price really didn't go higher here in early July. It's more just a weakening momentum scenario here, right? With, overbought the second week in June and now not overbought as we're retesting those highs just above 370. Just like with the S&P, I think a break above that level, break out of that base really, indicates further upside to be had. There's a lot of news about this, and just to take a step back and explain, there's another ETF called QQQE, which is an equal weighted ETF that's based on the Qs. And the reason why that's topical topical right now. They just made an announcement that there's going to be a reshuffling of the weights in the NASDAQ 100. We've talked about that narrow leadership, how the mega cap stocks, the FANG stocks, or what we call the phenomena stocks, have dominated and become bigger weights in the NASDAQ 100 for sure, even the S&P 500, to where the top 10 S&P stocks are the same weight as like 350 plus of the smallest S&P stocks. That's how narrow the leadership has become. As a result of that, the NASDAQ actually announced they're going to be lightening up. They're going to be recalibrating the index a little bit, taking the mega caps down a bit and juicing up the weight in some of the smaller companies. It sounds like a very toppy thing in my head, like where these stocks have become so big, we have to redesign the index. There actually is a reasonable justification for that. A lot of money managers are restricted in terms of how concentrated they can have a portfolio. So if you don't bring the weights down, they can get into trouble regulation-wise by having too much concentration in some of those mega cap names. But again, it sort of fits into that thesis of overvaluations, Apple getting above a $3 trillion market cap. Here's the latest bullet point on that argument of the mega cap trade has gone about far enough, is you have to reshuffle the index because those weights are so top heavy. And we've talked about that top heavy nature of a lot of the sector ETFs as well, the XLK, the XLY, and others, the XLC, Communication Services, all 2 or 3 stocks that make up about half of the weight of each of those sectors that I just mentioned. Let's switch gears a bit and talk about some non-equity asset classes, one in particular, crude oil. So crude oil having a nice move to the upside. I'm bringing up the USO, which is a crude oil ETF, but you'll see on the crude oil futures, same sort of move to the upside. A nice move higher. It's up over 2% on the USO, and the USO is actually testing its 200-day moving average today with this bounce. Now, what's interesting is crude oil prices have bounced off of a fairly consistent level of support over the last 3 months or so and now rotating higher. And again, I was taught by an early mentor, nothing good happens below the 200-day moving average. And that's a generalization about how to think about it, but it's always stuck with me of just remembering that when something's below, that just means the price, even if you get a rally, it's not significant enough to change that longer-term trajectory of the trend. Now we're starting to see maybe something different. The USO actually attempted to get above the 200-day back in April, fizzled out. The question would be, is this time different? Actually, the last 3 times we've attempted to get above the 200-day, we have failed to do so. Is this time different? And do you see a rally in energy or in oil prices from here? Now, energy, of course, very tied to the strength of crude oil prices, although there can be some disagreement for sure, depending on the nature of things. But overall, when you're looking at the XLE, it's a pretty impressive bounce off of the lows. Just like crude oil, just like the USO had that support level, the XLE also has a support level here. If you draw a trend line from the highs in January and the highs in April, which would be the 2 major high prices through the course of the year, you're drawn to the fact that we're now sort of testing that level. I'm drawing the trend line here, right? Take this trend line from the peak, kind of draw it there, and you can see what today's price action, we're actually powering right above that trend line. So when something's in a downtrend, a trend line like this can be really helpful because as long as we remain below that trend line, how good are things actually getting is the way I tend to think of this sort of visual representation of the trend. All of a sudden, we break above that trend line resistance, and it tells you things might start to be different, what we might call a change of character in the chart. So we've gone from making lower lows in March to now making more stable lows, right? Retesting that support level to now starting to make new swing highs. We're back above the 50-day. We're getting above trendline resistance. The momentum is starting to get more in the bullish range. I think crude oil potentially at the opportunity and energy starting to improve from here. Now, if you're looking for opportunities within the energy sector, again, I think this is a great opportunity to use our scan engine and focus on stocks with particular technical signals. One of the things I like to do is just look at our scooter rankings, which is a StockCharts technical ranking. That's a simple momentum-based model focusing on trend on 3 different time frames: long-term, medium-term, short-term. Noble Corp, ticker NE, is currently the top-ranked stock in the energy sector in the large cap space. You can run similar screens in mid caps and small caps as well. Noble's making a new 52-week high this week. And so you're actually seeing, even though the XLE is sort of down here, just starting to get above trendline resistance, you see some other names, more of the leading names, actually starting to break to new 52-week highs. Those might be some of the areas to focus in on. Just to finish off with some of the names that I'm seeing on the move that I think you might want to be aware of, ROKU. Talk about a stock we have not talked about in a long time, because way back in sort of the right after COVID area, the meat of the COVID area, names like ROKU just ripping to the upside as you saw this great bid for emerging technology and the promise of unlimited upside in some of these names that really spoke to the environment in the COVID era. Late 21 to 2022, ROKU got absolutely crushed. Around, coming from, mid triple digits down to below $50 to bottom out here. From there, we've actually retested the 200-day. We've broken above the 200-day. We've pulled back. And now this level of resistance right here is $75 a share. That's the peak from February. So after that initial rally in 2023, we fizzled out around 75. We retested it here in June. And we're now back above that level today. We'll see if there's follow through the remainder of this week. That's what I always like to look for. And again, generally speaking, this is a name I'm less interested in. I'm way more interested in stronger stocks that are pulling back a little bit. But I can't deny something like this that has been an underperformer for so long, now starting to show some signs of strength. Rotating from weakness into strength is pretty important. Now it's moving higher, over 11% today. But again, testing key resistance, and I think that might be an important one to watch. Coinbase is another one to highlight, another name that's been underperforming for quite a bit, although not recently. It's actually held in there just fine. Similar to ROKU testing the highs from February. If you look at the chart of Coinbase, we can see the high in February, the high in March. We retested that about a week ago, around $80 a share, and now breaking above there today. Another name up almost 10% today. Extremely overbought with the RSI over 80. You can see the relative strength starting to improve. It's tough to buy into sort of a vertical move like this, and I totally get that. But one of the things that I like to focus on are stocks making new 3-month highs and 3-month lows, because that tells me something's different. Something was in a certain range and now it's changing. Something had been in a basing pattern, testing resistance, and now it's breaking it. So I think Coinbase really speaking to, of course, the upside potential in the cryptocurrency space. Bitcoin, Ether, we've talked about. Coin getting above $80. One of my guests recently, I forget who that was. It might have been Leslie Jufloss comes to mind. Someone, we were talking about Coinbase. I'm going to make a note to go back to that video. And if you missed that interview, you might want to check it out, see what was said and how the picture has changed since then. That's it for our market recap. Couple quick announcements before I bring on today's guest, John Lewis. First off, we welcome your questions. Our mailbag is a lot of fun. It's fun to sort of hear what questions you're running into as you are trying to apply the technical toolkit, trying to use the StockCharts platform and make better decisions for your portfolio. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment @FinalBarSCTV. And on the YouTubes, just put a comment below that video that you're watching. We'd love to hear your feedback, love to hear your comments, and we hope to answer your question on our next mailbag segment. Also wanted to let you know we have a summer promotion happening at StockCharts. If you have ever considered becoming a StockCharts Premium member, now would be a really good time to do that, running a flash summer special in the month of July. You get up to 30% off your paid subscription. If you are a current member, by the way, you can get the special rate and just extend your current membership at the promotional rate. Go to stockcharts.com/special for more information on what's included, what it means for the different levels. And if you're at a certain level and if you've ever thought about upgrading it, now's a really good time as well to lock in a much lower rate. So stockcharts.com/special to find more information. I'm super excited to bring on today's guest because I've known John and his work for quite some time. I finally convinced him to come on the show. I saw him in New York at the CMT Symposium, and it's a pleasure to talk with John in this format. John Lewis is a portfolio manager at Dorsey, Wright Money Management, coming to us from Los Angeles. It is great to see you, John. How are you?
I'm doing great, Dave. Great to see you as well.
So we've known each other for a while, and I've always respected how you apply technical analysis, and I would argue in some ways in a non-traditional way. You're more of a strategist, more of a quantitative thinker, thinking about modeling how we can look at price behavior. But at the end of the day, we're all looking at the same information. We're looking at price and trying to figure out what comes next. Just to start off, John, give us the high level. Where are you at right now in these markets? We've had this run higher. We have the S&P and the NASDAQ sort of testing new highs for the year. We're in a seasonally weaker part of the year now going into the summer. Where are you at right now in terms of the trends?
Well, I think we're right now, we're at where we've been for most of the year. So we like people being overweight equities, both domestic and international. We like underweight fixed income, but it's been a very interesting year for what we do and for people that do momentum strategies. We've spent a lot of this year with a lot of reversals, a lot of laggard rallies. And what we're finally seeing now is these momentum strategies starting to regain their footing. We're starting to see these strategies really kind of get into a good spot where we think we can capitalize into the second half of the year.
It's well said, and I'd love, John, to start with your first chart, a point and figure chart. Of course, you're connected with Dorsey, right? Tom Dorsey, one of the experts in point and figure charting. So I appreciate you starting us here. We're looking at small caps. Now, small caps in area of market obviously has been underperforming mega caps. That's been one of sort of those themes. Do you see that changing here, and why?
Yeah, I think so. Most of the stuff we'll talk about today, and Dorsey Wright is really known for strength. We're always going for strength, but this is kind of a catch-up play. And I think what we've seen in small caps is they've gotten to a spot where they've underperformed these large caps and the mega caps by such a large margin that there's going to have to be some sort of catch-up there. So just looking at, say, 2-year trailing performance, for example, very recently, we had small caps underperforming the S&P by historically high levels we hadn't seen since 85, 91, 99, 2000, and 2020. And we all kind of know what happened after those periods. You also, Dave, you talked about that NDX rebalance, right? And that's kind of a big thing, right? Where kind of these mega caps have rallied so much. And if you look at a relative ratio of the NDX, say, to the Russell 2000, that's back up to levels where it was in March 2000. So I don't want to say that tomorrow we're going to change and small caps are just going to start ripping and the mega cap trade is over. I don't think that's the case. But we deal a lot with retail financial advisors who are dealing with the public. It is very, very easy to get underweight small caps when mega caps are working, right? Why bother with them? And so what we see is a lot of people underweight this area. It's probably a good idea to look at your portfolio, see where you're positioned. And if you're underweight small caps, it's probably a good time to add some exposure in there because we've seen the breakout today. And there's a lot of signs that we could have some catch up from small caps.
So not to ask you to do the 30-second elevator pitch on point and figure charting, that's way below your pay grade, John, but we do have a triple top breakout today on the IWM. What is it about the point and figure chart that sort of helps you understand that rotation, and why is it a compelling idea of thinking about the IWM given that pattern?
Yeah, so point and figure, it's really an objective way to look at trends, right? And it gives you very clear and objective signals. What we see today is we've broken out past previous highs, right? That's always what we want to see from trends, whether they're absolute price trends or relative price trends. We want to see higher bottoms, higher tops as we go through time, right? No matter what sort of charting you're using, whether it's candlesticks or point and figure or line charts, we all really want the same thing, right? We want a chart to be moving up and to the right on the page, right? And as long as we're making higher bottoms, higher tops, that's a very, very good thing.
Well said. Thank you so much. That was not planned. I appreciate you having a really good answer to that. And I think great justification. I think that's a beautiful illustration of the benefit of point and figure, just seeing that nice breakout here this week. Let's switch gears on one of the sectors that I think has been, sort of off people's radar, industrial, sort of in that value space, now really starting to reemerge. What do you like about the chart of the XLI here?
Yeah, XLI, we think looks really good. So we've got this kind of multi-year breakout here. In our asset allocation work, in our sector work, it's at number 2 behind technology, as you might expect. So when you get up there into the 1, 2, and 3 positions, those are the sectors that really tend to outperform, right? And so we're constantly looking for strength. This is an area that does have a lot of strength in it. This is also an area. A lot of people are waiting for a recession. They think the market might not do well in the latter part of the year. There's tremendous dispersion in analyst price targets for the remainder of 2023. Well, if the economy is going to fall apart, if the market's going to fall apart, this is not really something you see, right? You don't see industrials breaking out. We're seeing discretionary, for example, do better versus staples. This is one area that looks real good. There's a bunch of stocks in here that look really good. A bunch of different industry groups look really good. So I think under the hood, too, there's a lot to support this move higher.
It's interesting within industrials, you have a bunch of different, as you mentioned, bunch of different groups that are in there, right? You have airlines, you've got heavy construction, machinery, and things like that. It strikes me as more of a diverse sector, sort of like a consumer discretionary. So if you're looking at industrials for the first time and looking for opportunities, you mentioned some of the leading areas. Is it something like airlines that have already had sort of a move to the upside, or any particular groups within industrials that are more compelling in your mind?
Yeah, so we tend to look at things from a fairly long-term basis, right?
Mm,
And I think the construction and engineering group looks very good. That Quanta Services, ticker PWR, looks very good. Also, support services, something that's not going to knock anyone's socks off, but Cintas, CTAS, right? I mean, that's as boring as it gets, but that chart looks good, right? We've got a big kind of multi-year breakout there. And also a little more racy, kind of that electrical components group as well. Eaton, I think, looks pretty good
mm.
there, and AME looks really good too on a little pullback. So there's in the transportation area, you mentioned airlines. I think there's a lot of good looking charts in trucking as well. I think that's kind of where we would focus.
It was very kind of you to mention a Northeast Ohio company for me. Thank you, John, as an Ohioan. I appreciate that. We'll finish off here looking at your third chart, Meritage Homes, right? So the home builder space really has been fairly strong. I feel like a lot of people have reasons why home builders should not be working, but the charts continue to disagree and they go higher. MTH, a good opportunity here, yes or no, and why?
Yeah, so you're right. I think a lot of people aren't on this home builders trade. They think with high interest rates, they're going to have problems. But if you think about it, with where rates are and where people took out their mortgages, a lot of people can't sell their home and buy a new one,
Mm.
right? So you got to go buy new homes, right? There's that inventory just isn't there. So Meritage Homes has a really nice trend. It's kind of in that small cap space, which we talked about earlier, but there's also a lot of other stocks that look very good on a home builder space besides Meritage, Lennar, DHI, NVR looks good too, although that's a really high price stock. And then even some of the kind of the building materials places like Builders First Source and stuff like that. So
Sure.
there's a lot of good looking names out there. A lot of them have pulled back recently and provide, I think, pretty attractive entry points.
It's so interesting when you think about some of the names you're talking about. Just looking at some of these charts in industrials, John. When you think about how how our benchmarks are weighted so growth oriented, we have this rebalancing come up. How much of a challenge is it for you thinking about the benchmark, thinking about something like the S&P and the big overweight in some of those mega cap names? How much of a challenge is that for you in trying to outperform that sort of benchmark?
Yeah, it's very difficult, right? And you've seen even in indexes having problems, right? Because they've grown so much, they've got to kind of do something semi-active here and get things in line so that we can have these investment products. But it is very hard to do it. We tend to not market cap weight our different strategies. We tend to either equal weight or even factor weight, right? So that makes it a little tougher. In a very kind of mega cap driven market, it's just harder to perform with something like that. Now, when we get into small caps, which we might be seeing, as I mentioned earlier, then it becomes a little more easier to generate alpha, to do things, to find different pockets of strength and really capitalize on those over time.
So we have an inflation number coming out. Obviously, the inflation story has been a big story here in 2023. As a longer-term investor, a little more model-oriented, what do you do around a week like this with a big number, which has obviously some significant market-moving potential? Do you have a view on a number like that and position somewhere around it, or do you just more sit back and let the price movements play out as they may?
Really, the latter, Dave.
Yeah.
We don't try to predict anything. We are really focused on momentum, relative strength, and constantly pushing the portfolio to where the strength is. We don't really want to get into the prediction game and kind of paint ourselves into a corner. We want to remain super flexible, super adaptable. And we think the best way to do that is just straight old school trend following, letting the price tell us what we need to buy, what we need to sell, and just do it in a super mechanical and disciplined fashion.
We only have about a minute left, John. I feel like we could talk for an hour, and I hope we can continue to pick your brain in future shows. But when you're looking at names, some of those big growth names like an Amazon, a Microsoft, and Apple, some of the ones that have really been leading higher, I would assume you're still probably happy holding a name like this as long as it continues. But can you just give us a high level? What would you be looking for? What would start to convince you to rotate out of a name like this? Are there particular technical signals or patterns or like a stop in mind that would tell you, okay, things are now really different on a chart like Amazon that has been a leading name for recent past here?
For us, it's generally performance relative to other things in the universe. So
Yeah.
when Amazon, Apple, anything like that starts to really outperform other things in the universe by a fairly significant percentage, we're looking to get out of it. We tend to look at much longer periods than a lot of other investors. So, it might have to underperform the market by 20% or something like that. But we can get very mechanical signals on our point and figure relative strength charts or our different ranking systems. And we just have these very mechanical places to sell securities and move into something stronger.
John, this has been an absolute pleasure. I really appreciate you sharing some charts. Thanks for bringing point and figure. I feel like we've been underweight point and figure on the final bar, and I appreciate you sort of laying out why that makes sense for small caps. Be well, stay cool there in Southern California. We'll talk to you again soon.
All right. Thanks a lot, Dave.
That's John Lewis. John's a portfolio manager at Dorsey, Wright Money Management. Tom Dorsey, if you're not familiar with him, you should read his books. The first book I actually read on point and figure was one where he related point and figure charting to football and talked about the offense and the defense being on the field. I never forgot that. And every time I use a point and figure chart, I feel like I'm hearing Tom Dorsey's words talking about how to consider offense versus defense, how it's reflected in stock prices. Great discussion there from John Lewis. Particularly, I like his focus on relative strength. And I know that about John and his work. It's really focusing on what's outperforming, what's underperforming, and taking a step back and recognizing some of those longer term shifts. I find so many investors that want to be longer term just get drawn into the short termism, right? One economic piece of data, one Fed meeting, one day's price movements. Think about the bigger picture and how some of those trends are evolving over time. You have the opportunity to really outperform. Great opportunity to learn from someone like John Lewis at Dorsey Wright Money Management, coming to us from Los Angeles. We have to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We talk about breadth a lot of times, didn't talk about it in our market recap as I'm thinking about it, but one of the charts that I wanted to highlight at the end of the show today is the bullish percent index on the S&P 500. So what I like about breadth indicators like this is they are equal weighted measures, right? It's counting out of the 500 stocks, how many of them are fitting a certain criteria. And having a point and figure expert like John Lewis, someone who knows the craft well, I wanted to highlight the bullish percent index, which basically turns point and figure charts into a breadth indicator and how many stocks are showing a bullish signal most recently. Our indicator for the S&P 500 just went above 70% this week, and I'm highlighting in this these red shaded areas the previous times over the last 18 months or so when it's gone above that 70% level. Now, going above 70% usually means we're in an uptrend, but a lot of times at the latter stages, because you look at when we come below that 70% level, that's when we've had some meaningful drawdowns. And that's been in a down phase like 2022 or 2022, and also up phases like 2021 and the last 6 to 8 months or so. So the fact that we've gotten sort of that overbought condition using this breadth indicator tells me sort of that pullback theme, that pullback story in the short term certainly could be a reality we face going through July into August. Chart number 2, the financial sector. I wanted to highlight with the XLF using a simple framework using Fibonacci analysis. The way that I'm doing this is looking at the unadjusted data. So on our platform, we put a little underscore before the ticker. That'll unadjust the data. So basically taking all the dividend adjustments out of it. Our normal price data adjusts for dividends because that makes your indicators a lot more purely looking at investor behavior. By looking at the unadjusted data, you have a better opportunity to focus on actual price levels over time and seeing what price levels have meaning. If you take the high from January of 2022 and the low from October of 2022, you'll find that the 38.2% level around 34.20, the 61.8% level just above 37, often have become significant resistance levels and support levels. The reason why I wanted to highlight it, besides the fact that it's been a pretty good framework for this sector over the last 6 months, is the fact that we're right back to that first Fibonacci level again, which means getting above 34.20 here in the remainder of this week really sort of completes that bullish rotation. Now that we've gotten back above the 200-day, I would say based on this, upside's around 37, maybe a retest of those February highs. This is in financials, which have been clearly one of the underperforming sectors year to date. Finally, I mentioned in our market recap, names like ROKU and Coinbase. These are stocks and charts that have been struggling for quite some time, but really starting to develop basing patterns and now starting to break above there. I think it's still early on something like Coinbase. And what I mean is I think there could certainly be opportunity for upside. Reaching resistance is important. We saw retesting the February highs in March, but what we did not do in March was actually follow through and break out. Today, we're actually getting a nice move above that resistance. Can we hold that $80 to $85 range? And if so, this could be that signal of a rotation higher in a key cryptocurrency-based stock. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to John Lewis from Dorsey, Wright Money Management joining us from Los Angeles. All of our previous interviews are stored on our YouTube channel, so if you missed any of our conversations with some great market strategists and traders, go to our YouTube channel and check out some of the recent interviews. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.